Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
John Boivin of BlackRock writing, we now see even more cause to stay risk-on and overweight US stocks. John joins us now for more. John, good morning.
Good morning.
Just explain yourself, sir. Why?
I mean, it boils down at the end of the day, huge amount of uncertainty. Of course, we've been going through that this year. We don't think there's much insight in saying that anymore. It's really about how you get a handle on this. And I guess our strong conviction is that, when you look over the near term, we have more certainty about the outlook than we would have over the next few years. So that's a very unusual environment we are in right now. And over the near term, the world cannot change very quickly. So there'll be, noise, there'll be headlines, there'll be attempt to do stuff. But there are immutable laws at play, and that's going to shape the outcome. So we tend to, overall be, pro U.S. assets, and at the same time, try to fade the extremes that you're going to see coming both ways. Actually.
There is a distinction, though, when you say overall be pro-U.S. assets between stocks and bonds.
Yes.
What is the difference?
Well, the difference is that we like equities and bonds, I think, are more tricky in this environment. And so U.S. equities, we think there's powerful mega forces that are at play. AI is a big theme. We continue to believe in that. That supersedes, I guess, the near-term trade noise and so on. But when it comes to the bond and fixed income, but government bonds in particular, we have a lot of things at play that are, for us, pointing towards higher yields, higher long-term yields, term premium that needs to reappear, and so we remain underweight, U.S. Treasuries as a result.
Is this a U.S. story, or is this a global story at a time when I believe that you prefer European bonds, even though they're still issuing a lot of debt and facing some of the same kinds of issues?
It is a U.S. story to the extent that we think that's where the repricing is the more serious. It's also related to the greater uncertainty we have around the Fed outlook, the inflation outlook, the debt picture. Whereas in Europe, inflation is on the way down. You can tell a very credible story for why inflation will surprise on the downside. The ECB has more room to cut even from here, so that leads to more support for European bonds.
So overweight U.S. equities, underweight U.S. government bonds, while you're overweight European government bonds, maybe underweight European equities. I'm just wondering if you could give us a sense of the last time, just to sort of frame this out, that you were less exposed to U.S. Treasuries, particularly on the longer duration versus European ones. When was the last time you had this dynamic in BlackRock's portfolio? Well,
we've been, for the last few years, constantly underweight U.S. Treasuries. So we've been of the view that inflation was a structural phenomenon in this environment, that rates will need to adjust. There's a fiscal story that is not the new thing of this year. There's been a deficit story post-pandemic that was putting pressure on yields. So that story has been with us for a few years now. That has been one of the strongest conviction we've been having throughout that time. And there's been new layers now added to this, which it's unusual to say we've been structurally underweight U.S. Treasuries for so long, right? You would have been tactically moving around that, but that's really a lasting story for us.
When it comes to these new layers, you're probably mentioning, at least thinking about the one big beautiful bill. Why didn't we see more pushback from the bond market?
Well, I think there is a lot of structural demand still for U.S. Treasuries. So the reason why we're underweight is not a bigger sensational story around U.S. exceptionalism being questioned, or it's not about U.S. Treasuries not playing their safe asset role as much as they had in the past. So we're not questioning the fundamental structure of and there is there's going to be a need, a structural demand for this. So I think the markets are adjusting. There's no panic so far, but it's drifting up. I think there's room for digesting some of the big, beautiful bill that came through. And then there's a lot of question now on how it's going to come next. And so, I think it's going to be up. Yields are going to go up. It's going to be absorbed over time towards with higher yields.
You're saying this at a time when the president's talking about sending out more letters where tariff rates look very similar to what happened on Liberation Day. Do you think Trump has primed the market to basically absorb his aggressive policies?
Well, I don't know if the president has primed the market in any way, but I think we have more conviction ourselves since April 2nd and April 9th that what I talked about before, the immutable laws cannot change quickly in the near term. And one part of it is the bond market to actually connect to the previous discussion. The U.S. relies on foreign funding for that debt that we're talking about. That's maybe something that we would wish to be different, but that's the starting point. That cannot change overnight, and I think that's going to limit the maximalist approach that you can expect to see, and we've seen that on April 9th. To us, it was the bond market that really provided the discipline at that point. And we've seen it, so I guess that gives us more conviction that going forward, that's going to still be a constraint for the time being, at least.
That's an interesting thing to think about. Do you still believe that any potential sell-off in treasuries will be self-limiting because of that very fact?
I think so. I don't think the U.S. can sustain a massively higher yield. Even though we are underweight and we think yields are going to go up, it has to happen in a fairly gradual manner. And if there's any sign that this is like a very quick resetting, and we're in a world where we have 5% 10-year yield quickly on a sustained basis, the whole budget arithmetic that is already pretty challenged, I think, is out of the window.
So 5% is like a ceiling for you on a 10-year?
Well, I think if we're sustainably in a 5% world, I think that changes the picture quite a bit. I don't think it's a ceiling. I mean, will depend on what the growth outlook is and so on. So I don't think there's a hard ceiling, but it's a different world if we are adjusting to 5% sustainable.
Well, can I ask you then, why is it so different given it's only 60 basis points away? Why is 60 basis points so important?
I think it's not so much the 60 basis points, but this is now the kind of the norm, 5% that we expect to see over the next few years. That is a different world than we had 4.4. It might bounce back and up. So that's more the sustained aspect.
You and the team have been pretty consistent about this now for a number of years. At a time when a lot of people have started to price in rate cuts, back away, then price them in again. You've been very consistent about this. There are structural reasons to expect inflation to remain higher, and you think bond yields remain elevated. How convinced the clients of that story right now when you tell it?
Well, I think I find we're very convinced about this story, and I think there's different views out there, but I think it's less now. We have less pushback than we would have had maybe when we started to hold that view in 2022 and so on. So I think this has become in some ways more consensus. So less pushback, I guess, in that sense. But yeah, no, I think that's not an easy, hard sell, I guess.
John, appreciate your time. As
Thank
always,
you so much.
John Boivin there of BlackRock. With us here in New York, Ed Mills of Raymond James. Ed, good morning.
Good morning.
It is July 9th, and we have limited clarity. How much additional clarity will we have on August 1?
We'll have more clarity. I don't think we'll have a lot of the details. I think the whole goal this year is to get as many MOUs signed as possible, because I think what President Trump really wants to do is say, I got a trade deal with 112 countries. They're going to buy trillions of dollars worth of goods, even more trillions of dollars worth of market access, and we're going to work out all the details later. And I think that one of the good things about having this little extra time is what you need to do to get one of those MOUs is not all that complex. If you can work it out later, that's fine. And that's where I think the market is okay. As long as we have this extra time, sign the deal. And when you look at the letters that are going out, the new rates are not that much worse or sometimes even a little bit better than April 2nd. So we're okay.
The new rates are basically April 2nd. It's basically Liberation Day Part 2. But in this letter, Trump does say that perhaps you could consider adjustment to this letter if you decide to come to the table. We may reconsider. But then yesterday he said, it's August 1st. These are the rates. We're not going to be adjusting. Which Trump do you believe?
The next Trump. I mean, the only constant here is change. I mean, so I don't necessarily think that August 1st is necessarily a hard and true date. I don't necessarily think these rates are hard and true. I do think that there is going to be 3 buckets here. Bucket number 1, new revenue. We have a huge new tax bill that is costing trillions of dollars, the most expensive bill in the history of the country. He needs that revenue. Bucket number 2, protect national security. Those are the sectoral tariffs. If we are at war with China, what do we need to make here in the United States? And bucket number 3 has always been, can we use the force of the U.S. economy to force policy change elsewhere? That piece is always going to be the hardest part, and that's what all of these negotiations are about, Anne-Marie.
So who gets a deal today or tomorrow? I'm thinking of 3 in particular. Japan was supposed to, but they got the same second rate. India, I was getting tons of text messages yesterday saying it was imminent. I still see no language on it. And the European Union, which seems to capitulate on a 10% across the board tariff.
Yeah, I think the most likely is India, then Japan, and I think the least likely is the EU. I think one of the issues with the EU is the United States is asking Europe to make a decision. Are you with the United States or are you with China? And there are competing interests. You look at certain countries and they're like, absolutely the United States. A lot of that economy is tied to us. Others have more exports going into China. Because they are a bloc with disparate interest, I think that's going to be very hard to get anything on the tape by April 1st. But I do think that Japan, India, Australia, a large part of the GDP globally, can get a deal by August 1st.
Don't want to get into psychoanalysis here. What is it, though, about letters? Because it's always a letter. Why does everybody get a letter? And what is the importance of this versus just a verbal warning, maybe a presidential tweet? You know, what is it about a physical letter getting sent out that it has some import for President Trump?
Yeah, I think it shows action. I think it shows kind of the ability to kind of flesh it out a little bit more. These letters, if you read them, they're basically the same, and they are very clearly dictated exactly by him and probably edited by him, because it's like you see Trump's voice in these letters. I do think that there has been a concern by President Trump that the taco trade is out there and that he always caves. So he wants to show and project this strength that if you don't come to the table, this is what you get. I think the biggest questions from the social media posts in these letters are some of the details. What does it mean that you'll have higher tariffs if there's transshipment? We do not have a structure in place to deal with kind of how that country of origin would be different. That's why I think the details here are going to take a long time, but he wants to say, here are the general parameters. This is what I want. You come to the table, you tell me what you're going to give me.
I'm taking notes, parenting notes, because I plan on sending letters to the household, and we do have a complaint box already. I am wondering going forward whether the reaction or non-reaction that we're seeing in markets is sort of emboldening him to send some more letters and to raise those rates up even higher.
Yeah, I think that's one of the big questions from clients yesterday at Raymond James is that after April 2nd, what got him to pause these on April 9th was the market reaction. And we've had these conversations so many times. What caused Congress in the past to raise the debt limit is the market reaction. And so are you in this dangerous place that if there is no market reaction, then you can get even more aggressive? And at what point is a mistake made? I don't think we're close to that, but I do think there's always a threat that if you need the market to correct and you don't get it, then you get more bold. The biggest change I've seen so far in this market is early on in administrations, they mostly focus on process. Later on, they focus on outcomes. Right now, this is a market that is saying, all right, the process might be changing, but the outcome is not likely to change. The only way we get a market reaction if they think the outcome is actually going to be materially worse than what they actually expected.
What would a mistake be? How do you characterize that?
Yeah, I think a mistake would be actually going to 50% with the EU and that sticking on for a period of time. When I was in Europe 2 weeks ago speaking with investors at Raymond James, there is a real concern about the weakness of the dollar and exports getting more expensive coming from Europe into the United States. And then you have tariffs on top of that. That could be a recession. Does that kind of have unintended consequences? We talk about, looking at yields here in the United States. We saw after April 2nd, the 30-year go above 5%. Does the 30-year kind of in the 10-year start spiking as we start issuing debt over the next couple months to refill the Treasury General account? And does he put pressure on the Fed to bail that out? And then there is a bond market reaction. Those are the things that I think are the biggest debates for the second half of this year is kind of the rate path.
That last point, the Federal Reserve. What are you telling clients about the Fed race?
So I think that, I know that there is news out this morning that Hassert and Warsh are considered to be the front runners. I'd put Waller and Bessent into that camp as well. I think Donald Trump loves people to compete for the job. What I'm watching to see is, does Michael Barr step down as one of the Fed governors now that he's no longer vice chair for supervision? If he does, Hassert or Warsh is probably going to get that seat. Kugler, another governor, her term expires in January. That is probably the second seat. And then all four compete to see who can be the Fed chair come the May expiration of Powell's seat, and who is going to be the most dovish, who's going to be the most supportive of his agenda, gets it. It's a perfect scenario for Trump to have another game of apprentice, but this time for Fed chair.
Or Game of Thrones, equally as brutal. That situation, some names are more credible than others. Let's put it that way.
Yeah, or Bachelor. I mean, who gets a rose, right? I mean, we could put this on a whole host of different shows. This does raise a question, though, about how much the market's going to be voting, to your point. You know, who they're going to vote off the island. Love Island, maybe another one.
Yesterday, when the president was once again saying that Jay Powell is terrible, he then looked over to Scott Bessent and said, "I like you better." And that made me think, oh, maybe Bessent is back in this race and it's not just the Kevins.
Can you imagine these guys on Love Island?
I was just going to say, this is like
you mentioned it. I don't know where you're going.
I mean, it just feels, like, playing for the love, and you only get love if you say what I want, and that's sort of a toxic relationship.
I didn't know you watched Love Island.
Want to know more about the complaint box? Save that for another time.
It's true. It comes out once a week.
Okay. Ed Mills and Raymond James. Ed, thank you, sir.
Thank you.
Joining us now to discuss the former Trump trade advisor, Kellyanne Shaw. Kellyanne, good to see you.
Good to see you.
I'm sure you've been up all night. What's the advice to clients?
My advice to clients is to take the day off, see how this plays out, and then come back in 2 days and a week and see what the tariff landscape looks like. Because right now, this is the end game of a massive, massive negotiation, and there's just as mixed substance as there is theater. So if you're making real business decisions, you're best just taking a beat and waiting it out and see where things land.
Having worked for Trump, is this the final moment where he's trying to extract the most concessions from all these countries?
I think that there is a lot of that in this. And what's so challenging about watching Trump from the outside and what makes him such an interesting negotiator is that there's just as much mix of substance as tactics. And so trying to understand the forest through the trees can be very difficult. But I do think this is the end game. And I think he's trying to say, okay, country X, country Y, you've given me this deal, but are you really going to give me more? And that's what he's trying to get.
Who is the White House most focused on right now?
In terms of the foreign trading partners, so they've talked about these 18 countries. We've heard anywhere from 18 to 30 important trading partners. I think those are the ones that the administration's really focused on trying to land a deal with.
You think this is the end game, so that we're going to get some clarity on August 1st? Is that what you're telling clients, that essentially this isn't just a deadline that's going to be moved to September 4th and then October 1st and then on and on?
Well, both, right? So at the same time as we do have this August 1st deadline, and the president doubled down yesterday on True Social and said, no, this is a firm deadline. They have also said that if you don't like your tariff rate 6 months, a year, 2 years from now, you can come back and try to lower that through negotiations. So I think we'll certainly see more certainty, and I'm actually hopeful that we do well in advance of August 1st, because Customs needs time to adjust the HTS, give importers notice of what those tariff rates are, and that process alone can take a couple of weeks.
I just wonder how much some of this leverage is getting lost in the increasingly extreme rates and the increasingly extreme tactics. Does that actually end up bearing less fruit after using it many times? And that's sort of the question that you see in markets, is a lot of people shrug this off, and frankly, some of the rhetoric that we're hearing from the trading partners saying the same thing.
Well, I think I'm hearing different things from trading partners, anywhere from sheer panic to blasé in terms of some of these tariff rates that have been announced. But what I would say is this is very typical of President Trump's approach to negotiations. And I do think that tariffs will go up. The question for me is by how much and with respect to what trading partner. And so, whether this is the boy who cried wolf, I don't think so at all. I do think that the tariff rates are going to go up, but are they going to go up to 36% on Indonesia? Are they going to go up to 40% on Myanmar? Maybe not. Let's see where things land.
What I'm hearing from you is that his tactics are actually working on the other side of the negotiating table. Would you say that's correct?
Yeah. Having talked to a number of trading partners, there is a bit of let's pick up the phone, find out what's going on, and see how we can de-escalate this happening.
Now, when he comes out and announced something, maybe for India, because he said he basically signaled that yesterday, I had heard that this was imminent. Is it going to be a framework like he announced with the United Kingdom, or we get more substance and details to it?
So India is a bit different than some of the other negotiations that are happening. This is more like a broader trade agreement. So I expect the deal with India to be about a subset of issues versus these reciprocal deals. I do think will look more like frameworks with the substance of those provisions and the details to be negotiated moving forward.
Just one point, one dimension of this that I think we all find really interesting is transshipping. Mm-hmm. How much progress have they actually made so far to stop the flow of trade going from China through other countries and into the United States?
Well, this is an active debate in Washington right now. What does that word transshipment mean? Does that really mean ships that are going from China to a third country like Vietnam and then to the United States? Or is it a reference to this concept of a rule of origin? Meaning if you've got Chinese content in that supply chain, you're going to be paying that 40%, that higher tariff. And if that's the case, Vietnam's between a rock and a hard place, as are many of these countries, because China does not like that idea or that provision. So we'll have to see what the administration means by that when we see the actual text.
Outside of Vietnam, what are the countries you're tracking on that issue?
So the president has had the transshipment issue in every single letter that he sent out. So Japan and Korea have it. I think this means a lot for Southeast Asia because so many companies moved supply chains after the original 301 tariffs and Trump 1.0. So this could really hit them.
Kellyanne, appreciate it. It's good to see you in person too, here in New York. Thank you. The former senior Trump trade advisor, Kellyanne Shaw. Lazar of Piper Sandler with this to say: investors might be done with tariffs, but we doubt Trump's tariff agenda is done with investors. Nancy joins us now for more. Nancy, good morning.
Good morning.
What is guiding you at the moment? What convinces you of that?
Well, to be sure, this administration wants higher tariffs. They've already put in higher tariffs, and they're going to stick. We've accepted the fact that tariffs are here to stay. Why? We do need a freer trade backdrop, and two, I think misguided. This administration thinks this is positive for the United States. I'm a free market economist. Tariffs are a bad idea. Nonetheless, I have to accept that they are indeed here, and they're going to be a negative impact on the economy. It's a regressive tax on consumers. Lower-end consumers are going to get hit more because of these higher prices. And same for small and medium-sized businesses. Larger businesses might be able to plow through this, but the smaller, medium-sized part of the economy are going to get squeezed from these higher prices.
When you take the politics out of it, is this more inflationary or more of a slowing growth type of ramification from the tariffs?
Well, near term, it's a tax. It's a hit on the economy. Whether or not it turns into sustained inflation depends upon what both monetary and fiscal policy do. I would worry about the Fed stepping in and cutting rates too aggressively here, because that would just increase the odds that these price levels indeed stick. When you've seen tariffs before, when we had some back in 2018, it was a price shock. You saw it in furniture, household appliances. You initially had that increase in price, but then you had a decline in demand, and that eventually led to lower prices actually for household appliances and furniture. So it depends how sustainable these are on what the Fed does.
I want to just hone in on something that you said. If the Fed cuts, you think that would lead to more protracted price increases and more sort of entrenched inflation. What gives you the confidence to say that at a time where we're seeing on the margin some slowing in consumer spending and certainly deterioration in consumer confidence?
Well, as we saw, and this is nowhere near as extreme as we saw during the COVID crisis, you can have a temporary shift down in demand, but inflation is a function of what the Federal Reserve does, monetary and fiscal policy does. So even though you had that shift down in demand in 2020, because both monetary and fiscal policy eased so aggressively, you then net had price levels stayed elevated with that supply chain disruption, and then you had the inflation in 21 into 22. So near term, yes, we are having a shift down in demand, which could lead to lower prices, say, later this year, next year. But if the Fed were to cut rates too aggressively, then I would, again, be worried about inflation in 2026. And I thought your point on the bond market here is going to be really important. The Fed cut rates last year, 100 basis points. Everyone seems to forget about that. They cut rates 100 basis points in the fall of last year. What did bond yields do? They rose 100 basis points. So the Fed controls the short end of the curve, and I think some of the administration understands that, but they have to be careful of the long end.
Will the Fed have enough information to cut by September, given the fact, especially that the tariff deadline has been pushed out to August 1st?
I worry about that because we saw that the employment report on the surface looked healthy. Underneath the hood, it was actually a weak employment report, but on the surface, it looked healthy. I would have thought it would have been easier for the Fed actually to have cut rates here in July, where you really still have tame inflation and signs of an economic slowdown. I worry by September, you could have maybe a clearer signs of a weaker economy, but stickier inflation. I am hearing from retailers that they're done with inventories. The pre-tariff increase in inventories, they're fading. Now they are going to be selling these higher price products in the third quarter related to the tariff increases. So I worry about September.
But a cycle or one price adjustment?
Again, for right now, it's a one price shift up in price, as we saw in 2018, but we don't have the conclusion. It depends upon how aggressive the Fed is.
When you say you're worried about September, are you worried about the price side of things?
Yeah.
Or are you worried about what could happen to the labour market if they have to absorb some of this on margin?
Well, I think you're going to increasingly hear stagflation as you go through the third quarter, because already you're seeing consumer spending stalling out. Already, again, under the hood, the labour market is deteriorating. Unemployment claims are probably the easiest number to show that, cleanest number to show that. So I worry that as you go through the third quarter, the Fed is going to have to really balance it. On one hand, you will have a weaker economy. GDP growth, we have less than 1% in the third quarter, probably a higher unemployment rate. But then the inflation data could be also more sticky, and you're seeing it in the data. Shelter was a headwind to inflation in the second quarter. Is that going to continue into the third quarter as these tariffs make their way through into the data?
And that's, as you know, there's a range of views at the Federal Reserve. This FOMC is incredibly divided. One view, I think is quite important at the moment, is Governor Waller's view. And Governor Waller is making, I think, a credible argument to say you should look through the inflationary effects, potentially, of tariffs, and maybe think about reducing interest rates. Do you find that particularly compelling?
I don't. One, I think if you look through the tariffs in aggregate, the economy actually is on a healthier footing. This is a soft patch. Volatility created from the uncertainty and the tariff and the price increases. As I've said before, and I focus a lot on capital spending. You have incremental fiscal stimulus for 2026. Importantly for capital spending, which has boosted potential GDP growth already. You don't need a lower interest rate environment, as some of you've reported this morning. There's a lot of liquidity in the markets. That's why this M&A cycle is picking up, and I would be leery in cutting rates too aggressively. One, the economy is healthy with stronger potential GDP growth. We have basically a 4% unemployment rate. Cyclically, it's going to go up a little bit, but we don't need lower interest rates. This is not 2008-9. It's not a COVID crisis. I think rates should stay where they are.
So, John, I was thinking as Nancy was talking, if you wanted to explain stagflation, there is one economist, Donald Trump, who really put it perfectly when he said just a few months ago, maybe you need just $2 that cost a little bit more rather than 30. And maybe that's what we're seeing trickle out into the economy.
Is that the argument he's making now?
I don't know if he really wants to go back to that.
Quite the same thing.
Maybe not. I do wonder, though, about where the inflation comes from. If you do see consumers in not as strong of a position, you pointed to the labor market and the weakening that we're seeing in certainly the private payrolls report. Where is it going to come from in terms of fueling the ongoing ability to absorb the price increases?
So it will have to come from stronger corporate profits. Because if you have a stronger corporate profit backdrop, then you'll get a stronger labor market, you'll get bigger wage increases. And so near-term profits are under pressure. 2Q earnings are probably going to decline, not year over year, but sequentially, which is why you have this weaker labor market. So you need this soft patch to end, which we think can end on its own without lower rates in 2026. Because of this incremental fiscal, and importantly because of the capital spending cycle. And so the investment cycle fuels productivity. Productivity fuels profitability, and that then net is how you get a stronger job market.
Nancy, we hope you're right. It's good to see you.
Nice. Thanks for your time.
Thanks for dropping by. Thanks for your time. Nancy Lazar there of Piper Sandler.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.